This is Adrian Pellin
and David Bocott,
co-leaders of NFP's construction and infrastructure practice. Given interest rate increases, economic uncertainty, and looming belt-tightening in commercial construction, we expect the growth in the construction sector to be focused on supporting the energy transition, addressing the housing crisis through multifamily development, harnessing infrastructure funding, and bolstering onshore manufacturing capacity given the rise in geopolitical tensions.
Construction spending in many of these instances continue to remain focused in jurisdictions prone to high liability costs like New York, California, Texas, Colorado, or states subject to high CAT exposures, for instance, flood, windstorm, and wildfires. With these considerations on the horizon through the year end and beyond, we expect continued focus on underwriting discipline across all product lines. While interest rate rises give the insurer some additional flexibility in underwriting performance in theory, the sheer volatility of underwriting losses due to nuclear verdicts and catastrophic events leave little room for error.
As a result of property treaty renewals on June 1, we also anticipate significant upward pressure on builder's risk pricing and deductibles, particularly for Gulf Coast construction projects. We also continue to see lower CAT limits being deployed. So insureds can anticipate layered programs with CAT rates increasing anywhere from 20 to 100% in some instances. Outside of nuclear verdicts, we see stabilization at large in the casualty market, whether for COBRA programs or project-specific placements, as rate escalation is moderated from what we've seen over the past few years. Those insureds with heavy investments and risk controls are seeing benefits in their results. And given current trends, we anticipate flat to 10% increases on the horizon. We anticipate continued deterioration in market capacity for project-specific professional liability coverage, given underwriting has performed poorly in the recent past. Not uncommon to see rate online of anywhere from 70 to 80% in some instances for design-build projects. The market for subcontractor default insurance will largely remain flat throughout the second half of the year. We are, however, on the lookout for what is anticipated to be an active default season given the tightening credit cycle that we're entering. Insurety pricing has largely remained static throughout the first half of 2023. Capacity remains abundant, but we do see a major focus on project bidding discipline given the volatile macroeconomic environment for construction companies.
We also anticipate the following trends will be of increasing importance throughout the remainder of the year and beyond. Number 1, technology. We've continued to see the emergence of retail and wholesale insurers as well as MGAs look to redefine their underwriting approach while providing rate and/or deductible credit for a client's optimized use of project management or built environment technologies. We fully anticipate this trend to continue. Number 2, data and analytics. Insureds with robust data, both claims and legacy exposure data, are best positioned to articulate lessons learned and to drive an optimized path forward. Number 3, risk financing. With the cost of risk continuing to escalate, we continue to see the use of self-financing vehicles playing a more prominent role not only in corporate renewal programs, but also for the adoption and application for project-specific vehicles. Number 4, emergence of MGA and facilities. The construction industry continues to see a proliferation of MGAs with a variety of product lines. We expect these trends to continue given the industry's reliance on wholesale markets and difficult to place classes of business.